They're actually talking about stopping the taxation of your Social Security. In today's video, we're going to talk about the law. We're going to also discuss how to calculate how much money it means to you, especially here in California, and then we're going to give some examples. Let's jump into the video. Before we jump into the specifics as it applies to you, let's talk a little broadly about the law itself. So before 1983, Social Security was not taxed. And then they passed a law at the federal level, which would then allow them to tax your Social Security depending on your income. We're going to get into the components that feed into that so we can look at your specific situation. So after 1983, and for 10 years, they had separate brackets based on income, 3 different components that they would then tax. And the theory was that, we're going to make it more like pensions, where what a pensioner puts in doesn't get taxed, but the gains and what the employer puts in would get taxed. So the kind of basis for this change was, hey, we want to make it more fair and consistent with what they're doing on the pension side, private pensions, but really is probably more to shore up Medicare. They could see the writing on the wall that money was going to run tight, so we need to start the tax to essentially help pay for Social Security going forward. All right, so that's the basis of it. And then in 1993, that lasted for 10 years, they adjusted basically the income ranges they were going to allow the taxation to occur above. The fact is, right now, most people are paying, especially in California, are paying taxes on their Social Security, especially because income in California tends to be higher. Even if your Social Security, which is part of the equation, is fixed, people make quite a bit from capital gains, from rental income, because they're still working, especially in California because it's more expensive to live. Incomes tend to be higher. So more and more people are over that threshold where they have to pay taxes on their Social Security. Now, in Washington, regardless of politics, where you are, they're talking about removing taxation on a host of different things, including Social Security, which can be a lot of money. It can be 50%, 85% of a certain percentage of your Social Security that potentially you could get back. So that brings up the question, what's our income we're looking at as we dive further down into the calculation piece? Let's turn our attention to that now. To figure out what we're paying in terms of this tax now, we have to look at 2 pieces. And we're going to borrow or lean heavy on the 1040 tax form, which is our federal tax form. And that's where all of this happens. So first, what income qualifies to see if we're above or below the threshold? There are 3 pieces. First, you have the AGI, the adjusted gross income. Right now, that's line 11 on your 1040 tax form. And that kind of captures most of your main income. Rental income, W-2, self-employment, capital gains, interest, all of that kind of flows into that main bucket, the AGI. In addition to that, we add tax-free interest. And you'll see there's a line on the 1040 that specifies your tax-free interest as well. That's municipal bonds, state, county bonds, things of that nature. It's not as common, but a lot of people do have that. And then finally, the third one is your Social Security, how much you received in Social Security. Now that's based on prior income. A range of income during your life captures that amount. And usually it averages about $2,000 a month right now. It can go all the way up to around $4,000, but we'll go based on $2,000 as an average. So those 3 pieces, the AGI, tax-free interest, and Social Security, make up the income they're going to look at to determine whether or not we're currently paying tax. We're not going to look at the old 1983 stuff. That's old news. We're going to look at the current situation as it stands right now. All right. Now we're going to turn to income thresholds that are based on being either individual or filing jointly. And there are different numbers to look at. Let's turn our attention there. We talked about the income pieces that figure into this. Now let's look at the thresholds to see if we have to pay this tax at all right now as it stands. So there are 2 numbers to look at for a single individual, and then we'll talk about filing jointly. For a single individual, if your income is below $25,000 for those 3 components, you shouldn't have to pay any tax towards your Social Security or on your Social Security. That's good news. Hard to do in California, but that's good news. If your income is between 25, and 34,000, expect that 50% of your Social Security is going to be subject to tax. All right, that's not great. And then if your income is above the 34,000, expect that 85% of your Social Security is going to be subject to tax. That's tricky. All right, so now let's look at jointly to see what those thresholds are, just higher numbers. So for a couple filing jointly, if their income is below 32,000, then none of the Social Security should be subject to tax. If their income is between 32,000 and 44K, then half of their Social Security is subject to tax. And if their income is above 44,000, expect that 85% of their Social Security is subject to tax. Now, what does that mean? When I say 50% is subject to tax for an individual, it means that, let's say we make $2,000 a month or get $2,000 a month in Social Security, that's $24K a year. Half of that, so $12,000, is now going to be taxable income. And we'll show you on the 1040 where this actually figures in. But whatever your tax bracket is, let's say it's 12%, that 12% is now also going to apply to the 12K. All right, this gets complicated. So let's give some examples to show how this actually looks, how much money might actually be at stake here if they remove the taxation altogether. Let's turn our attention to that. All right, let's start with a pretty typical example of what this might actually look like if they get rid of the tax. Let's take a single individual making $50,000 in California, which is pretty common out there these days. And let's say that they get $2,000 a month in Social Security. So out of that 50K, 24,000 is from Social Security. All right, we have our two pieces. The 50,000 is what we look at to see if we meet the threshold. And unfortunately, we're over that 34K now. So 85% of our Social Security, or the 24K, is now going to be subject to tax. That's $20,400. So that means $20,400 will now get added back in and applied to our taxation. So the way to look at that, let's say that person pays on average about 12%. They're in a 12% tax bracket. Well, then you would apply 12% to that $20,400 because now it's going to be taxable, which means about $2,448 of their taxes is because of their Social Security. So if they get rid of that tax at the federal level, that person could expect to have almost $2,500 more in their pocket after tax filing season. It's a big deal. That's one example. Now let's look at a couple filing jointly. Let's say a couple earns $100,000 and $30,000 of that is Social Security. So right off the bat, the 100K is going to put us over the limit where we get to the max percentage of Social Security subject to tax, 85%. So we take the $30,000 of Social Security, we multiply it by 0.85, and we get $25,500, meaning that's the amount that's going to be subject to tax. Let's say that couple is at a 0.22 tax bracket, 22% essentially. And so we're starting to get up there a little bit. We're going to pay more in taxes. Their real tax after tax difference would be $5,610, meaning we multiply the $25,500, the amount of Social Security subject to tax, by their tax bracket, which is 22%, and we get $5,610. So if they get rid of that law, all of a sudden they're going to have $5,610 more in their pocket after they file taxes. It's a big deal. So as you can see, it's a big deal. It's a couple $1,000s potentially people can save if they get rid of the tax on Social Security. Now, right now, we still have this tax. They haven't passed a law. It's not even at that process, but they're talking about it. It's on the table now. So potentially they're looking at it, and it can mean a lot of money back in the pockets, especially here in California, because when we look at our clients or help them with things around Medicare, Social Security, most of them are above that 85% level, which means 85% of their Social Security might come back to them if they get rid of this tax. And it's a big deal, especially in California. Again, we like to make sure all our clients are up to date. They're able to take advantage of things that might save them money. So if this information has been helpful, please subscribe, like, and we'll continue to bring this to our viewers. Let us know what you want to learn about. Let us know what can help you the most, and we'll get right on that. Thank you very much.